Hi, my name's Brett Marsh. I'm CEO of the Pentafin OneVue Managed Accounts business. We've been really proud today to sponsor the Financial Standards Managed Accounts Conference. Earlier I spoke on Will Managed Accounts Make Managed Funds Obsolete? This is the cut-down version. I want to talk about some of the advantages and some of the features within the separately managed accounts that will make them a growing force as a preferred vehicle within the industry. I also want to touch on platforms. What are some of the drivers behind separately managed accounts becoming a growing force? In the States, separately managed accounts have become a fairly significant part of the industry, and many of you would have seen the stats on that before as to how that's grown into a multi-hundreds of billions of dollars industry, and in fact into the trillions now. It grew out of the broker market, and in some ways brokers have already led the market here within the managed account space. For brokers, the driver here is that they create annuity-based income streams. So the typical broking model is transaction-based. You clip the ticket on the buy, you clip the ticket on the sell. But what a managed account does is, for a broker, it creates an annuity income stream, and for their clients what that does is it creates that overlay of professional management. For advisors, there's a couple of things which are going to drive advisors towards this. It is intrinsically a better quality product for clients. I'm talking a little bit too early on this one here as being a driver, because we'll go through some of the features in a moment. But it is a more efficient vehicle for advisors to use, and potentially there are some advisors who will be looking for new income streams within this market. There are advisors now who run separately managed accounts or individually managed accounts where they become the fund manager and they're bringing the funds management in-house. And so for some advisor groups who have that capability and prepared to take on the responsibility and the licensing of being their own fund manager, they can create their own portfolios for their clients. This can either be done at an advisor or a dealer level and creates a new income stream which they may be giving away at the moment. The other way advisors are potentially going to move their clients into the managed account space is via platforms. And for platforms, they will complete their offering by offering best-of-breed service providers. Some platforms will probably take the function in-house, but many look at the moment to be looking outward from their organisation to find the best-of-breed service providers. So what you'll find there is managed accounts being offered through platforms working with managed funds for advisors to use for their clients. Anecdotally, I've spoken with a number of platform providers, and many platforms at the moment are experiencing flows into their platform of 10 to 30% in the direct share space. And what that does in the direct share space is the structures that sit on platforms now mean that almost all the time when those direct shares come onto the platform, that it is client by client and stock by stock. I'd argue at a very broad level, if we got the definition of a managed account to the lowest common denominator, there actually do have managed accounts sitting on platforms now in the most inefficient way you could possibly do it, and that is you're having to trade in this online broking type model where an advisor or someone in an advisor's office has to go in for each client and buy and sell their stocks to complete the investment strategy for their clients. And there are advisors out there doing that at the moment, and they're employing small leagues of administration staff to assist them. I'll now move on to talk about separately managed accounts and platforms. Platforms, as mentioned before, are the dominant force and the dominant vehicle for financial planners within this market. So what they have is a current state, and I want to compare that with the future state, because this is where the industry really needs to go to bring around advisor efficiency. And in this particular market, where trails are falling, it's harder to get new business for advisors. The ability to make practices more efficient and to bring value add to advisors' clients are key things for sustainable advisor practices. At the moment, investing in direct equities is quite cumbersome and labour intensive for advisors. As I mentioned before, client by client, stock by stock, employ administration staff. The future state with managed accounts is where it's simple and quick for advisors to set up portfolios. The execution becomes on a pooled basis without having to actually pool the assets. Model portfolios are operating outside the wrap. I refuse to believe that there are advisors out there just using a scattergun approach with their direct equities. They are creating portfolios on their spreadsheets, and they're going in and executing those portfolios in the inefficient manner that I just described. But model portfolios sitting inside a wrap or a platform are going to be the future state, where it's seamless for advisors to execute on their models. In the current state, depending on the structure that you use, but many advisors are having to issue multiple statements of advice when they advise in direct shares. And in the future state, it'll be a single statement of advice through the use of a managed investment scheme. The current state, there's often an unknown risk for a dealer group. In the future state, by actually bringing that compliance forward and the visibility under a managed account structure, the dealer groups get to fully see what is going to be invested in prior to execution. When we get back to trading efficiency, there's no auto rebalancing, which are offered on platforms at the moment. In the future, that will be automatic. There's no tax optimisation or tax loss harvesting as much as is legal. I know there's a tax ruling, which I'm sure our accounting friends will explain later in the morning. But in future, it'll be built in, and as much as is legally able, there will be the ability to tax loss harvest. Corporate actions are currently handled individually, which may work fine for your very high net worth clients, but at the at the mass market level or even the mass affluent level, it's actually the economies of scale come into play by being able to centralise that. And at the moment, the brokerage and the transaction costs are high. That's why you don't see systematic rebalancing, because why would you do it for your individual client with such small amounts?